the greater economy, what we're hearing right now, there is a consumer confidence report that is basically saying it's at like a real low. There's a builder confidence report that's at a real low. And Ringmaster Drew Barnhill is putting in here in reaction to what we're saying. Stock market has been sucking up all the capital. As the market sells off, bonds will get paid and bring down rates, right? So there's just like a bigger picture of all these things that are happening around us. Tell me, when you're thinking about like the consumer sentiment being low, from the brain of a real estate investor, what is pinging for you?
What I am rooting for as a real estate investor
Yeah.
is I want lower interest rates,
Yeah.
right? I think our entire economy wants lower interest rates. So
Yeah,
it's not
true.
just from the lens of a real estate investor.
Yeah.
But if I'm just looking from the lens of a real estate investor, I want lower interest rates. I have been rooting for bond yields to go low for a while here because that I understand that's what truly drives our interest rates. When the Fed lowers or raises the Fed funds rate, sure, it's a part of it. But as you've seen, it's not correlated with what actually happens to our interest rates.
Yeah.
So I've been rooting for lower bond yields. And when I say I'm rooting for lower bond yields, that means that I'm rooting for more people to make the decision to invest in bonds, specifically 10-year bonds. Because if you have more demand for 10-year bonds, then the yield goes down because there's more demand for it. We've all been rooting for it for quite a while.
Yeah.
I think a better question is like, what does that mean? You're rooting for 10-year bond yields to go down.
Yeah.
We have to look at why do those bond yields go down? Why do people decide to buy more 10-year treasuries? And the reason is because people become a little bit more scared in this economy. Now, I'm not rooting for people to be scared, but I understand that when people are feeling really good and really opportunistic, they put their money in the stock market. When they're a little bit more conservative, they're going to take a little bit of a pause. They want a little bit more of a safe haven. They're going to go to the debt instrument, which is a 10-year treasury or any type of treasury. So the things that are driving yields down are the things that are scaring people in this economy. And there's certainly some things to scare people in the economy. We can kind of go through a number of them, but when you start to understand these 3 or 4 things that are giving people some pause, you understand why money, like the Ringmaster was mentioning, that why people are taking money out of the stock market, putting it into bonds, and how ultimately that's a very good thing for our interest rates.
But people are doing that. They're putting money into bonds. You hear reports of like Warren Buffett is sitting on a ton of cash. You're hearing like fears of a recession, stuff like that. Like what's driving that? Like what are people pointing to that is giving them such fear, right? Like I have to assume that the political news cycle right now is just bludgeoning all of us, right? And we are bludgeoning each other from it. And that can't be fun, right? Like the war stuff, everything else, the tariffs, like nobody knows what's coming with any of that stuff. And it feels very uncertain on whatever side of the coin you're at. What else? Like what are the economic indicators?
Well, I think there's a combination of like the feels that we feel as an economy, which really does have an impact on where people put their money. And then there's certain economic indicators, and they're all painting a picture right now for a lot of folks and just saying, I'm going to pause. I'm going to pause. And a pause means I'm going to put it into a debt instrument, like a 10-year treasury. So, I mean, we'll just talk about the feels a little bit, right? When people are scared or people don't understand what's going to happen today, tomorrow, the next month, 6 months from now, they don't make decisions. If they're lucky, they put it into a very safe, debt instrument. Sometimes they just put it under their pillow.
Correct.
People hoard cash. People go to very safe investments in times of uncertainty. And between the wars out there, between the trade war, between the tariffs that we were talking about, just an incoming presidency creates a whole lot of unknowns. And that seems like we don't even talk about the fact that it's an incoming administration. So much there. And I think people are just they just don't know. And when people don't know, they don't take opportunistic chances.
It feels like out of all things, real estate is the most emotional asset class. Right. So I feel like
we think we know it because we live in one. We think we understand it.
Yeah, correct. And so it would make a lot of sense that we overcorrect for emotions in this asset class as investors, the same way that we, overcorrect for emotions with the way that we talk to property managers
Oh yeah.
or
Oh,
whether you're residents or whatever, right? So
yeah.
like, so that part of it makes a lot of sense.
And people get stuck in the feels
Yeah.
a lot.
Yeah.
But as a not your average investor, that's why we are here
Yeah.
to help you make good decisions when things become a little bit uncomfortable.
Yeah.
Which for real estate investors, especially for the last 3 years of interest rates have been elevated, it's been uncomfortable for us to make these types of decisions. Yet,
Yeah.
there's a reason that we collectively have generated over $307 million in the times when interest rates were high and the times when interest rates were low. It's because we can kind of navigate that. So maybe now is a good time to talk about the objective things that people are seeing. And
although the Maven says that stuck in the fields is a great description.
Yeah.
I like it. I like it. Stuck in the fields.
Yeah.
Don't get stuck in the fields.
Yeah.
I like it.
It's
so yeah. So let's talk about let's unstick ourselves from the fields. Let's talk about objective data.
Well, so the objective data is also painting a picture of uncertainty as well. And that's really why bond yields are going lower. And that's why our interest rates are going lower. So a couple of things. Inflation is the headliner. We have been talking about inflation for a long time. Inflation is something where when inflation is high, people don't want to lend money out.
Yeah.
So if inflation is high, that's actually something that is going to drive bond yields higher.
When inflation is high, people don't want to lend money out.
Yeah, it kind of goes back to this inflation hedging profit center within real estate. If you lend money out to somebody today and then inflation is raging, by the time they pay it back to you, your purchasing power is a lot lower for that same amount of dollars.
So it's the opposite of what we do when we borrow money to invest in real estate that keeps up with inflation.
You want to be a borrower during inflationary times.
Got it.
Yeah.
Got it.
So now these big money managers and people who are controlling hundreds of billions of dollars to potentially put it into mortgage-backed securities, they're watching the CPI. And there's the consumer price index, which measures inflation, is the easiest headliner measurement of inflation. And if they see inflation at, 6% or 9% like it was, they don't want to lend money out. They don't want to invest in bonds or mortgage-backed securities as much because they realize that the money they're going to get back in 7 years or in 10 years or whatnot is going to be devalued a lot because inflation would have eroded it. So does that make sense?
Yeah.
So long story short, when inflation is high and raging high, that's a bad thing for our interest rates.
Yeah.
That inflation high is likely going to lead to higher interest rates.
Correct.
Right. Yeah. And it also leads to a higher Fed funds rate, which is a contributing factor to it as well. So what's happened with inflation lately? Inflation actually is around 3% and it's gone down over the last, I think I put the chart up. I don't know if you want to put that chart there, but look at that beautiful CPI over the past 12 months. There we go. Pretty good from memory, right?
Yep.
So 3.8% is what it was. You can see it's come down. And so when you look at this and when big money managers are looking at this, they're saying, okay, well, I'm seeing some stability over the last few months. I'm seeing it come down. Now, when I put all this money into something, it's not going to get eroded by inflation. So it makes more sense for me to invest in bonds.
To lend.
That's right. Yeah. Or to invest in mortgage-backed securities as well.
Got it.
So that's a good thing for our interest rates. It's a good thing for the economy that our inflation seems to be somewhat in check and hopefully goes down a little bit lower. But this is one contributing factor as to why bond yields have gone down. They've been allowed to go down because inflation isn't eroding the money.
That sounds like good news though, right? Like what, so why is that making consumer sentiment worse, right? Like this feels like the silver lining of things, right? Like inflation is down because people aren't spending money and people are like lending and they're doing this stuff.
People don't get this.
People don't get this. So that's part of it.
But I'm really looking at it from the lens of a real estate investor right now. And what's allowing our bond yields to go down, what's allowing our interest rates to go down. This is something that's allowing it to go down.
Got it.
If inflation had roared back up to 4% or 5%, our bond yields would be higher than what they are today.
Makes sense.
And our interest rates would be higher than they are today.
Got it. Okay. So then let's talk jobs then.
Yeah.
Right?
So that's not something that really scares people.
Yeah.
This is something that starts to make people a little bit uneasy. And it's the jobs report. So every month, the country releases the number of jobs that were added into the economy. And the thing about it is, it's not so much about what the number of jobs added is. It's not the number, if the number increased from the previous month or is down from the previous month or what, it's less about that. And it's more about what did we expect that number to be and what did it come in at?
So did we meet expectations is more important than the overall number.
Exactly.
Okay.
Exactly. And so what happened in February's jobs report, we added 151,000 jobs, but that was below the expectation. We expected to add 170,000 jobs. And so when that happens, people are like, oh, is the economy constricting?
Yeah.
Are people losing their jobs more? Are we headed towards a recession? That's why you're starting to hear more about is a recession on the brink, right?
Yeah.
And again, on top of the feels, right?
Yeah.
People are scared about what is happening with the wars in the world and what that means for us here at home. And then people are concerned about the tariffs too. So you have a bedrock of feels. I don't even know if you can have a bedrock of feels, but you're on a foundation of feels right now that are concerning folks. And now you're starting to see some economic data that is a little bit concerning and might be a harbinger of maybe some tougher economic times.
Got it. So did not meet the prediction for it, which means, hey, we're not in as much control. Like the perception is we don't know what's coming. People like stability and consistency / under promise over delivering as opposed to over promising under delivering. And therefore now everybody's saying, oh, okay, could this mean there's something worse?
Yes, that is true. But I think it's worth noting that
Yeah.
the Fed
Yeah.
has been rooting for this.
Correct.
The Fed has signaled this,
Yeah.
and they have said,
Yeah.
we want, wage growth and the number of jobs to slow because, again, this is why this is this complicated thing, because if wages slow, wage growth slows, and the number of jobs added slows, that is a good sign for lowering inflation, which is the Fed's mandate.
Correct.
So through all of these, you can play both sides of this and say, is this a good thing or a bad thing?
Yeah.
But just through the lens of a real estate investor right now, if your focus is on how to get lower interest rates right now, missing our expectation for jobs added is a good thing for lowering bond yields, lowering interest rates.
Interesting. Okay, so we missed our job expectations. All of this environment's out there. I would love to is there anything else that we want to hit on here before we move on to builder sentiment?
Unemployment. So it's again to sprinkle on something else that concerns people. Unemployment ticked up last month. It went up to 4.1% for the country from 4%. Not huge, but again, if you're on top of all of these things that are potentially causing you to have some concern, you could draw the correlation and say, you know what, I'm going to be a little bit more conservative with my money.
Yeah.
Unemployment went up. We missed our jobs report, tariffs, potential wars, all that stuff. Okay, I'm a little scared. I'm a little bit more scared than I was before. And boom, I'm going to move my money to bonds. That's what's happening.
Got it. So unemployment ticked up, missed the jobs report, CPI. Okay, all right. Summarize the points there of like.
Yeah, this is what happens when money is scared.
Yeah, this is
when money is scared, it moves from the stock market into bonds. Just to simplify it, they move from something more opportunistic to something that is more of a safe haven, and that's what's happening because bond yields. Because people are moving to bonds, the demand for bonds has gone up. Bond yields go down, which is the greatest correlation to our interest rates, and that's why our interest rates have dropped about a half point, even though the Fed had nothing to do with it.
Okay, got it.